Hello, good day guys. My name is Crypto Kib and today I want us to discuss the type of trading. I will start with what is trading itself. So trading is a process or art of exchanging an item or asset for another item or asset. We all know what trading is anyways, but then it's always good to remind ourselves of what trading is in case we forget. Also, trading is also the art or process of buying and selling an asset or instrument for the purpose of making profit. So, who is a trader? By definition, a trader is someone, be an individual, corporation, institution, who buys and sells or exchanges an asset or instrument or an item or commodity for the purpose of making profits. Nonetheless, losses can as well be realized while trading. So you want to put that at the back of your mind. Trading is not an exact science. As anything trading is risky. As you can make profits, you can also make losses. So what are the types of trading or the types of traders? When we talk about types of trading, it is interwoven with approach, method, style, kind, as we can refer to many different kinds of trading as types. So I will try to follow a clear path of explaining this in my very own opinion. There are different kinds of trading, as we all know. As we have commodities, currencies, stocks, indices, cryptocurrencies, and securities trading, and then traders. Likewise, in analysis, we have both technical and fundamental analysis, and 90% of analysts are also traders. Therefore, we have fundamental traders and technical traders. You can be a commodity, stock, currency, which is FS, forex, as we all know, or crypto trader, and use either the fundamental or technical approach of trading. But you will still have a type of trading that you do, as trading can be done on different time frames and periods. So this is continuation of the types and method of trading. So the first type of trading or method of trading is scalping. As we all know, scalping is the opening and closing of positions or trades within a very short period of time in an attempt to make small profits off of each trade, thereby taking as many trades as possible within the trading day. As the saying goes, small drops of water makes a mighty ocean. Traders who scalp are called scalpers, and they prefer to trade on a very low time frames, which can be ticks, the 1 minute time frame, or even up to the 15 minutes time frame, as this can allow them to take multiple trades in very short time all through the trading day. So scalping, as we all know, many of us will refer to ourselves as scalpers. The scalpers, most time frame most scalpers trade on is from the 1 minute to 5 minutes time frames. Many also trade on the 15 minutes time frame, and they do not hold their trade for long. They hold the trade for maximum of 15 to 30 minutes and they are out. So if you can take a trade within 30 minutes, that means you can take more than 20 trades in a day. That is what scalping is. So now to day trading. Day trading is opening and closing of trading positions within the same day without holding the trade onto the next day. Traders who day trade are called day traders, and they can trade from the 5 minute time frame up to the 4-hour time frame. This is the most common form of type of or method of trading, and it is the most done by professional traders and specialists or market makers. Once you master the art of trading, you can as well day trade and trade professionally. We also know what day trading is, or we also call ourselves day traders, right? So day trading is virtually when you take a trade. For example, when the session begins the next day around 8 a.m., depending on your time period which you are, if you are on London session or Asia session, depends. But Monday is Monday, Tuesday is Tuesday. You take a trade on Monday, you make sure you close it on that very Monday. You do not hold the trade onto the very next day. That is what day trading is. You open a position within that very day, you close it that very day. most day traders trade from 4 hour down to the 5 minutes time frames. So this can enable them see setups and take the entry and also take their profit within that very day. Then we have the swing trading. Swing trading is the art of opening and keeping trades open from between a day up until weeks or months. Traders who swing trade are called swing traders, and they trade from the 4 hours time frame, daily time frame, and even the weekly time frame. Swing traders can open a position on the 4 hour and hold it open for weeks until their target is met. Swing trading is ideal for beginner traders, as trading noise from within the day are filtered out on higher time frame, and as it is said, higher time frames have higher precedence and higher accuracy over lower time frames. So many beginners, swing trading is what we all advise them to start with, because they can see charts and read charts on the daily time frames. All the noise within on the 15 minutes, the 1 hour, the 4 hour time frames, all the noise that happens within the trading day, they are all filtered out. As the chart becomes clearer, the higher time frame you go to, the clearer the chart becomes and the lesser noise. So you do not have weeks taking your stop out suddenly. So if you are a beginner trader, swing trading is what you want to consider, as this will give you the edge and you won't be under pressure to, like, you want to open the trade within the day and close it within the day. You can hold it for months if the trade is going against you, in as much as it is not yet up to your invalidation level. You can leave it open for as long as you are not invalidated and you are not yet in profit. So the moment you get in profit, then you can close it and take your profit. The next type of trading after swing trading is the position trading. This type of trading is mostly done by long-term traders or investors. This is a type of trading whereby trades are left open for a very long time, from weeks to months and even years, and can be referred to as a buy and hold. In crypto, we do call these people hodlers, people with bursts of sales. People who can buy some coins or open some positions and hold it for a very long time, no matter what happens. If they are in losses, they will keep holding it because they believe on a long time it will yield them decent profits. So the time frame ideal for position trading is from the daily time frame up onto the monthly time frame. Position traders, or rather long-term investors, have nothing to do with low time frames, as it is of no use to them because they are looking at very high time frame and not thinking of taking profits anytime soon. So with this in mind, let us look at some different styles of trading. I believe you already understand what swing trading, day trading, position trading, and scalping is. Scalping is taking trades on a very low time frame so that you can be able to open as many trades as possible and close them within very short time period. So in a day, you can take very, very few profits, maybe 2%, 3% off of each trade. But by the time you make like 20 to 30 trades, you would have accumulated much more profits. And day trading, you can take like maybe 2 to 3 positions in a day and you close them within that very day. Maybe you can aim your target to be from anywhere from 5 to 10% up onto 20 to 30%. As we know in cryptos, they are very volatile, so they can actually give you way more than that even within the trading day. And swing trading, you can accumulate much more profits, because if you open the position today, you can leave it up until the month end for it to have done everything you would like to do within that month and then go to your target. But this shouldn't give you the mindset that you can open a position at any particular time or at any price line you want. You also want to do your analysis on the time frame suitable for swing trading in order to be able to open a good position that will yield you the best profits as you have NPC. And position trading is basically investor style of trading, where you buy an asset and you keep it for a year or two, like people who have bought Bitcoin right from 2017 lows or 2018 lows and are still holding it to this very moment. That is the type of traders who are position traders. So trading styles. There are many different styles with which a trader can trade. But I will mention the most common and basic ones. So we have price action trading and we have indicator trading. Those are the two most common ones. Either you trade with price action or you trade with indicators. Some people may refer to them as strategies. It's okay, but then I refer to them as trading styles. So under price action trading, we have breakout trading and retracement trading. While under indicator trading, we have momentum trading and trend trading. So let's look into more details on this. So starting with breakout trading. This is a style of price action trading where the trader anticipates a price break up of resistance or a price breakdown of support and hope for a continuation of the move, thereby placing an entry above the resistance or below the support. This can be used with many strategies, including trend lines, patterns, and others. So if you take a look at these two charts I have on this screen, we have resistance here, as we have the first touch here, the second touch here, and the third touch here, which confirm this as resistance. So what do breakout traders expect? Breakout traders expect that when price visits this area and it breaks above up to an extent of this yellow line that I've drawn, where I wrote the long entry, they will be placing their buy stop at this very line. So when price comes above it, they will be filled in, and then they expect price to continue going up. So that is how breakout traders take their trade. I'm looking at it on this, as it doesn't just happen with trading support and resistance. It is the inverse for support. They expect support to break, and once broken, they have their stop sell under the support. And so once it breaks, it fills their order, and then it continues downwards. And this is a pattern, a symmetrical triangle. It is the same thing where you have resistance and resistance here. So they anticipate a break of this descending trend line, and then once price reaches where they place their entry, they expect price to run into it, and the moment price run into you and fills their order, they expect it to continue rallying. So let's look at how that played out. So this is the advantage and this is the disadvantages. So this is an example where I have the entry above here, we have the resistance here, we have the resistance here, and then what happened here, they have placed a buy stop at this very line which is the entry. So the moment price came back into the resistance, it broke it, filled their order, and then we saw the price running up. So at this very particular point, they might have placed their stop just below the filling candle, as we have here. This is where their entry is. So they got filled. So their stop is likely to be below this very candle or below this very candle. And then they will calculate their R, and once maybe here, if they have 2R or 3R, they will be taking profits as price is going up. And it is the same thing with this particular triangle where they have their entry waiting, and then the moment price broke above it, it filled their order, and then what happened? Price continued to rally up. So at this one, they might have their stop below the very filling candle or below the range. Depends on the individual. So as we can see here, it worked out pretty well. But then, what are the disadvantages of trading as a breakout trader? The disadvantage is when we see resistance here, 1, 2, 3, and then we anticipate that one price comes into an area of entry, and then we expect it to break above like this, and then run off. Sometimes we do get price coming into the area like we see in this very candle, this very green candle. We saw price coming into the entry, breaking the resistance here, filling their orders, taking the buy stop, and then running off. But this has not given the decent R which you would like to take, because at this particular moment, this long candle is a filling candle. So they might have their stop just below the candle. Placing your stop below here will be too far away. But then the issue is, most times, price will come into it, take your entry, which means you will be filled. You will not be holding this particular asset, only for price to close back under resistance and come here again and test this very resistance as resistance. Then price will drop. This means you will be trapped. If you have your stop below the filling candle, then you will have been taken out. But if you have your stop loss here, then you will have been taken out when price got to this particular level. which means you will lose much more at this point than here, except you have calculated your position size with risk management. So this is one of the disadvantage of trading as breakout, because many times SFP, which is swing failure pattern, will occur, or what we call stop hunting. Market makers may stop hunting because they know there are a lot of buy stop above here, people placing buy orders above here, so they want to trigger it and trigger their buy stop only to close back under resistance, retest this and resistance, and then price drops. It is the same thing as we see here, where we have the descending triangle, the descending trend line, which then price, they have their buy stop probably above here, then price came above, triggered their order, they got filled, only for price to close back below it and test it as resistance, and then price to continue downward. So they will be trapped, or their stop will be triggered the moment price goes below the failure candle. So that is the advantages and disadvantages of trading as breakout traders. The next is retracement trading. So this is a style of price action trading where the traders do not chase price. Rather, they wait for price to come back to their area of interest in the form of retest, at which point they will anticipate an entry for continuation of the preceding move. So in this chart, I have given examples of what retracement traders expect. We have the same resistance line, which is confirmed as resistance. Then we have the break above of resistance here, which means resistance is broken. So what are breakout traders anticipating here? Retracement traders, they are anticipating that price, the moment it breaks out, they will expect a retracement back to this broken resistance to be reacted to as support. They want price to find support at this particular broken resistance. So once support is formed, they expect price to continue back up. So they are waiting. As they have the breakout here, they are anticipating retracement, and this is the anticipated support. Resistance broken turns to support. It is the same thing as here, where we have the resisting trend line, then price broke above. The moment price broke above, they are anticipating a retracement back to the trend line, and then a continued move in the preceding movement. So they want it to retest and find support only to continue back up. So they are willing to place their order at this level, and probably this level where the price is likely to find support on retest, and then they expect it to continue to the upside once that is done. So let's look at how that played out. These are the advantages and disadvantages. Now we have the resistance, which is broken like in the previous example, and then what do we see? We saw a retest of this particular resistance, which has now turned to support. So which is why I have support here. This is the retracement. Now it forms support, price closed above it, and then price is rallying back up, which is what they expect, because they have their their entry waiting at this particular new support, and then it came to fill them, and then it's rallying off. Likewise here, we saw the breakout here where they anticipated the retracement. Then the retracement came the first time, it rallied a bit above, it came back for further retest. So they have one retest here, another retest here. So whoever wasn't able to enter this particular level is now given another chance to enter on this second retest. And then what did we see? We saw price running above in their expected direction. So once price comes for this retracement, this retest, they have their order waiting, and then once they are filled, they rally off, like we saw. The disadvantages of retracement trading is that sometimes when the resistance breaks and price rallies off with big momentums like this, we may not see a retest of this resistance to turn to support. Price may just continue going higher. We may see a break above like this, and price will come a bit down, but won't quite catch the new support, only to continue upwards. And then when this retracement finally happened, what did we see? We saw that price, after the breakout, price came back to the anticipated support, which is here, only for it to break down, retest it as resistance again, and then price continue dumping. So this is one of the disadvantages of retracement trading. When price breaks up only to come back, instead of finding support, you couldn't find support, only to break down again and then retest and resistance and continue downward. Then this whole move, like I said in my previous video, this whole move is deviation. But as a breakout trader, the moment breakout traders have their price above, probably above here, they are buy stop, and it feels them they are giving decent profit up to this extent for them to take profit before price crashed. Now looking at the triangular one, the descending, the trend line one. So here we have a break above of the resistance. So naturally we will expect the break above, then the retest of this trend line, then the rally above. But what did we get? We saw the break above, then the retracement, it did happen, but it didn't quite touch the trend line. So it didn't come into the region of the trend line, only to continue back up. So this is one of the disadvantages of retracement trading. Whereas breakout traders at this point, where they have their buy stop here, they will be filled, then retrace, and then continue in further profits. So that is the disadvantages of trading as retracement trader. Now we have indicator trading. This style of trading happens with the use of indicators and other study tools which are mathematically calculated and visualized to give the trader an edge in the market. There are different types of indicators, but they can also be categorized into momentum and trend, to mention a few. Breakout and retracement trading can also be implemented when trading with indicators. So we have the momentum trading. This is a style of trading which requires the use of a momentum indicator, such as the relative strength index, the RSI. This is the most common indicator used in momentum trading, and traders have several ways of using this indicator as it is very powerful. I will talk about one or two basic ways in which trader uses this, and that is buying when price is oversold and selling when price is overbought. This is not an indicator lesson, so I wouldn't be going into much detail on it. So let's see what happens with momentum trading with the RSI. So as we have here, this is the RSI, this is the RSI, and this is price. So what did we see? This bottom line is a 30 mark and this is a 70. It is believed that when price is below the 30 mark, it is oversold. While price is above the 70 mark, it is overbought. So whenever price is below the line 30, you want to start looking for buys. And when price is above the line 70, you want to start looking for sell. So what did we see here? We saw price coming down into this oversold region, which means you will start buying, taking your buy entries from this very point. And then what do we see at the end of the day? If you started buying the moment it were oversold, you could have been on the move of this big rally. And then when price was overbought here, you could have also said probably at this tip, and if not, probably at this level, which is still a decent profit from buying at these particular levels. There is another way people do buy when price is oversold. They want to see the RSI cross back above the 30 mark before they place their buys. So once this crosses above the 30 mark, as we see here, which is around this level, they want to place another here, which means they will be on this rally, which gave a lot of profit. And then the moment it crosses into the overbought region and it crosses back below the 70 mark, they want to sell. But then the problem is they will be selling when price has already dropped. So they are giving back a lot of profit back to the market. And then this is another example, the disadvantage, I believe. So we have price coming into the oversold region here, which means price crossed below the line 30. And this was where the price came into the oversold region. So you might have started buying here. If the moment price was oversold, you started to buy, which means you keep buying while price keep falling, which is not good. Depending on where you place your stop loss, you might be stopped out. Or if you decide to keep buying, scaling your entries until price crosses back above, that means you could have been buying all the way from this point up until this very point. And then if your first buy was this line and then price cross above the 30 mark at this point here, which means you want to buy here. Though those who are buying whenever it crosses back, they will be in profit because it crosses back above here, which is around this region. So they may be buying here and then they will be on profit to this point. But you that is buying the moment it is oversold, you will still be in loss and waiting for a break even, especially if you buy only once. But if you scale your entry by buying somewhere here, somewhere here, somewhere here, somewhere here, then your entry will be maybe probably above around here. So once price crosses above the 30 mark and it goes in profit, you will be in little profit. But then there is one thing. Notice how price is oversold here. I mean overbought here. But then here is the point at which price was overbought. If you are bought here when price was oversold and you are waiting for it to come into the overbought region for you to sell, you see, at this point, it is giving you just break even. It is giving you just break even, which means you won't be in any profit. You are just giving the chance of a break even. And then price came just a bit above and then we see it coming back down below it. So that is one of the disadvantages of buying when oversold and selling when overbought. We have extended oversold and extended overbought as well. Also, looking at this particular image here, looking at this particular one here, what do we see? We see price coming below the 30 mark here, which means it became oversold from this very moment. And if the moment it became oversold, you are buying, which means you'll be buying anywhere around this region. And the moment you have bought around this region, what happened? We have an extended oversold. Price remained oversold for an extended period. And when price was oversold on the RSI, what happened? On the prices, price was dropping, which means if you buy here and you are waiting, you will be in very big loss. But if you keep buying at every point when price remain oversold, then you might have a chance as your entry price will keep dropping. But there is also a way to that. And then if you also buy whenever the prices cross above this 30 mark back into the bullish or the neutral region, then which is at this point, that means you are giving a chance of little profit. But then price didn't reach the overbought region, which we'll be expecting price to reach at this point, only for us to sell. But price didn't quite get there, only for price to reach a point here and revert back into the oversold region. So that is one of the disadvantages of trading with the momentum, which is the RSI. Now, continuation of indicator. So we have the trend trading. This is another style where traders use a trend indicator, such as the moving averages or the moving average convergence and divergence, MACD. In the use of moving average, traders have many ways of using the indicators, but we'll be talking about the basic methods, which is looking for a crossover between two different MAs, which is two different moving averages, where one is fast and one is slow. Traders buy when there is a cross above and sell when there is a cross under between the two MAs. Another method of using the moving average is when price crosses and close above or below the moving average. We also have the MACD. MACD is another trend and momentum indicator, but many uses the MACD for its trend capabilities, which is the crossover and cross under of the MACD fast and slow EMA. So the MACD uses an exponential moving average, which is a bit, it's similar to the moving average itself, but this is calculated in an exponential, while this is a simple moving average and this is exponential moving average. Traders choose to buy when the fast line crosses above and sell when the fast line crosses below. The fast line on the EMAs is the one with the lowest settings. Maybe you have 9 and 26. You have the slow and the fast one. Just like you have when using moving average, the simple moving average. You want to have the fast one maybe with 11 and the big one or the slow one with probably 23, 30, 55. 100. Most people use 50 and 100 in the MA, whereas the MACD default setting is 9 and 26. So trend trading with moving average, the advantages and disadvantages. As we can see here, this is a moving average where the red one is the fast one. So probably the setting is 20, whereas the green line, the setting is 50. So what happens when we see a cross below? The red one crossing below the green one. The red one is the fast one, do not forget. Then you want to start looking for sell. The moment the price crosses below it, you want to start looking for a sell. So assuming you have sold when it crosses, which will probably be here, you will be in this much profit. Then the moment the price crossed above, where the red line crossed above the green one, which is around here, price may be here by that time, then you want to also buy, and then you will also be in this profit. One thing you want to pay attention to is where you place your stop, because if the moment it crosses here, if you are buying at this very candle or this very candle and you are placing your stop below it, as you see here, you will be taken out of that trade. But if you also place your stop loss just below the cross, which is below the MAs, then you will be in this very big profit. Likewise here, if the moment you are buying here on this candle, you want to place your stop loss above it, you see this long wick that happened would have taken you out. But if you have your stop just above the MA, then you will have enjoyed this very big profit. So you won't have anything to worry about. Then this is the second example. As you can see, most indicators are lagging in nature. This is a clear example of the lagging indicator. This is the same MA, the same setting as this. And what did we see? We saw the cross happen here just after the price has given us all this plenty more, and then price started coming down. So if the moment the price has pumped and then it's retracing down, then the MA is crossing. If you are just buying at this particular time, which means you want to buy at this any point on this candle or any point on this candle, you might have been in profit of this very move up to this extent, but then you may not be able to take profit because you will also be expecting a cross under before you sell. And then what happened? We saw price kept coming down. And then look at another thing. Here we have another cross below. The moment it crossed above here, if you are bought, price was descending, which means you are losing. Then price crossed below, which means you are to sell. And then we are now seeing price giving this little move, and then probably is going to cross back above at the next stage. So this is one of the disadvantages of using all these indicators. As they are lagging, most of them will give you the signal after the move has already happened. Also here, if you look at this course, if you are buying at this very point, then you have missed a lot on all this move that happened from this very lows up to this side where you would have bought. Then looking at another example here, this very one, as we can see, there is a cross under here. So you may want to buy when you see this cross under. So any of this candle, this candle, or any of the next candles is where you will have bought. And this is what I'm talking about stop placement. So if you are placing your stop above this very buying candle, you will be stopped out here. But if you have your stop loss above the range, which is like this, then you will be safe, and then you will cash all this profit downwards. Then look at the cross above here. See where we have this cross above. You want to buy whenever it crosses above, right? And the moment it crossed above, what happened? We didn't see any movement to the upside. We only saw just a candle to the a downside, then another upside, which is not enough to give you any profit, only for price to crash back down. And then what happened? The lagginess of indicators. When it crossed there, which is the point where you will be buying, you would miss out on all this extended move from this very low to this very high. So you are missing out on a lot of profit already, and then only to end up buying whenever it crosses, and then for price to come down again. And in this instance, where will you be placing your stop? Probably above here, which below here, which you will be taking out as well. Then what do we have here? This particular point, we have another cross under. Then the moment it cross under, You have a rally up, a small rally, which might be enough to take out your stop depending on where you place your stop, and then we now see it coming down. Maybe probably wants it to give profits. This is the second way in which I said moving average are being used, where you have just one single moving average, and whenever price closes above the MA, you want to buy. Whenever price closes below it, you want to sell. And what do we see here at this line here? We saw the price close above it here, then you want to buy the moment it closes above. So either you buy on close, and then you'll be in all these major profits. But where will you place your stop? Will you place your stop just below the buying candle, where you'll be triggered off here, or will you place it below the range? That is one thing you want to pay attention to. Then looking at the cross under here, we saw a cross under here, and the moment it closes under, if you are sold, then you will have been in this profit. But at this particular time, will you want to take profit, or you will be waiting for price to close, for MA to close above, for price to close above the MA again before you take profit? So those are the things you want to pay attention to. And then if you are selling at this point here, what happens to selling above here? You are missing out on a lot of profit. You are missing out on a lot of profit. So this reflects the lagginess of indicators. Look at another point here, where we have price closing above the indicator here. Price closed above it here on that very candle, and we saw the rally up. But are you taking profit at this particular point, or you are waiting? What did we see if you were to be waiting? We saw it close under. And the moment the price closed under, what happened? We saw it falling heavily. So you will be in profit on some, you will be in loss on some as well. And then one last thing. Look at here, when price closed above the MA here, we saw price closing above, you might be buying here, and then you'll be on profit for all this range. But then will you be waiting for price to close back under it before you take profit, or you want to use other strategies to take the profit? That is one of the things you have to consider. And then looking at this point, we have price closing above only to come back and close back below it. So sometimes you have many sideways action, and sometimes you just have it giving you very late entries. And this is the trend trading with MACD. Here you have the first line, which is a blue line on MACD. That is a 9 on settings, and here you have the 26, which is a yellow line. So once the blue line crosses above the yellow line, you want to look for buy orders. And once the blue line crosses below the yellow line, you want to look for sell orders. So in these examples, let's see what happened. So we could see here that the moment the price crossed, when the blue line crossed the yellow line, if you are to look for buy orders at this particular point, it could have been anywhere inside of this circle. And then what will you do? You will be in a lot of profit. But there is another thing. Where will you sell? Do you want to wait for cross below on the MACD before you sell? If you are waiting for a cross below, then all the profits you have made from this point up to this point, you will give it back to the market, which means you probably sell at break even. This is why I say indicators are lagging in nature. Then let's look at another example. Then we have this other example where the MACD cross at this particular line, then which is here. You may want to buy at this particular point, but is it giving you enough profit at the moment? No. So you wouldn't be taking profit. Now, this has to do where you are placing your stop. Are you placing your stop below the buying candle or below the range? If you are to be placing your stop below the buying candle, you will be taking off here. But if you have your stop below the range, you will be safe, and then you will enjoy all this profit. But then if you were to sell when the MACD crosses below, when it crosses under the yellow line, which means you will be selling at this point here. And if you buy at this point and sell at this point, you have very little profit compared to what you would have profited if you are sold at this very top. So the MACD is good for giving you maybe probably an entry, but will you use it for taking profit? That is one question you should ask yourself. And then if you are going short, assuming you are using it on a futures market and you are going short, the moment this crosses below, you want to go short. But if you had gone short at this particular area, what do we see happen? We saw price rally, which means you'll be stopped that automatically. Price never goes your way. Only for MACD to then cross back above here. So it's giving some reliable signals at times, and at times some lagging signals. I wouldn't say unreliable. And the moment it crosses back above here, if you are to buy, then you will have been in this profit. Then another one is this. We have the blue line crossing the red line here. So, which means you want to look for sell. If you are looking for sell at this point, if you place your stop above the buying candle, that means you will be taking that here. But if you have it above the range, you will be safe. But then is the distance from here to here not too far away? That is something you want to ask yourself. But then at the end of the day, if you have your stop just a bit above too, you will be in all this profit. Then when the MACD crossed above here, what do we see? You want to buy. But then this pump has already happened before the cross, which means you are buying here on this candle or the next, only for price to come down. And then if you had bought here, I mean you are sold here and you are waiting to buy back on this cross here, assuming you sold here and you want to buy back here, which means you are so probably somewhere around there and you will be buying back here, which means all this profit you have enjoyed, you will give it back to the market again and probably sell for little profit. So sometimes, many times, indicators trading is lagging. And even if you buy here, you miss out on all these trades from this very low to this very high. And then when you bought, price can only decline, trapping you as a trader. So many times, indicator trading gives us less reliable signals due to their lagging nature. So with indicators, there are so many ways or strategies to use them, including price or volume divergence, price and volume divergence, right? Then we can use indicators for confluences with other strategies, where you have one strategy, but you want to look at what MACD or the MA is doing before confirming that yes, the market is ready to go your way. But one very important thing, as we have noticed, is where to place your stop. That is very, very important to stop placement. So no matter the type of trading or strategy you choose, there is no perfect way to trade, as it is not an exact science. Neither is it brain surgery. You only need screen time, and you need to find a way to work around whichever type of trading you choose. With the knowledge of the different ways to take a trade, let's quickly look at the different ways to enter a trade. So these are trading entries, right? There are two common approaches of entries, which are, we have the aggressive entry and we have the conservative entry. So the aggressive entry is when you do not wait or you do not watch for confirmation that the price is truly wishing to go in your way before entering a trade. Most breakout traders are aggressive entry traders, while most retracement traders can be said to be conservative. There is also aggressiveness in entry when it comes to retracement trading. When a price breaks above resistance and even closes above it, there is no guarantee that the broken resistance will become support. What I'm trying to say is, if a support breaks, a resistance, if you see a resistance that a resistance is broken, there is no guarantee that when price returns to it, it will become support. As it can then break back below it and use it as resistance, then you have a deviation in price. So there is no guarantee that a broken resistance will become support. Hence, placing an entry at the broken resistance will be used as support is aggressive, as you may want price to confirm that price level as support before you decide either to take the trade or not. Now we have the conservative entry. Most indicator traders are conservative entry traders, and they wait for their indicator to show sign of bullishness or bearishness before taking the trades. Just like we saw with the MACD, you want the MACD signals to cross above or cross below before you take the trade. That means you are waiting for a confirmation. You are waiting for something to happen before you take the trade. That is being conservative on its own. But that doesn't mean there can't be aggressive taking trades when using indicators. There are aggressiveness in taking trades when using indicators as well. So the only issue is indicators will lag. So sometimes they get on the train so late and miss out on a lot of potential profits. Likewise, there can be acts of aggressive entries while using indicators. such as when price breaks above or close above a moving average and traders go long on that accord. Retracement and breakout traders can also be conservative with their entries, which is just by waiting and seeing proof that price is going their way before they place the trades. This way, they would not get trapped by the market, but they may miss out on some trades. Breakout traders can wait for a close above resistance in order to give them the idea of a bullish move, rather than a fake out, while retracement traders may want to see the resistance turn to support before taking a trade. And this is the final note. After all this is said and done, you should know that there is no perfect strategy or trading method. Any method or strategy you choose to work with is just as good as any other, provided you spend the time to study it and fine-tune it to your own taste. All you will ever need is a lot of screen time, studying charts with your chosen indicator or methods, and seeing what causes a reversal in price at certain turning points. That is all you need. If you're a fundamental trader as well, you may wish to find the news that caused a pump or a dump on certain instruments, and by so doing, you can ascertain the effect of news and events on a particular trading day. So that is it about the type of trading, guys. There are many other types of trading which I could not speak about, but I believe with more research, you will get to know them. Thank you all for watching.